everyone. I'm Susan Sarava with Comerica's marketing team, and I'm your host for our Outlook on America event. So happy you are joining us today. It's going to be a great event. We are joined by our Chief Economist, Robert Dye, and our Chief Investment Officer, John Lynch. Welcome, gentlemen.
Hi, Susan.
Thank you, Susan.
Great to have you here. We're going to get to the presentations in just a moment. Would love to have your questions for Robert and John. I'll be monitoring those, and we'll get to those a little bit later in the program. And many of you sent in questions when you RSVP'd for this event, and we really appreciate that. Robert, I'm going to go ahead and come to you now and let you know that we have questions about inflation and the housing market, the global chip shortage. We've been doing these events for over a year, and I think the best questions have come in over the past few weeks as people have RSVP'd. So really looking forward to your presentation and for you to cover all those topics. So take it away.
Thank you, Susan. And those are certainly very key questions. I've been able to go out and meet with some clients recently, and to a person, these issues about supply chains and prices and the impact on the housing market and other parts of the economy are really top of mind in this extraordinary economy that we find ourselves in. I think if we're looking for really broad overarching themes right now, I think we can identify two as we transition from the first half of the year into the second half, from the second quarter into the third quarter. And those two overarching themes are number one, the normalizing of economic data. We've just been through an extraordinary period in 2020 and in terms of the volatility of data, and we see that starting to normalize here in 2021. And then the other theme that I'd like to talk about through the course of the presentation is really all the policy levers that are still in place, and certainly key to the supply chain issues and inflation discussion is Federal Reserve monetary policy as well. So very much intertwined there. So an absolutely extraordinary economy. And let's see what that looks like with the very first slide, number one here, which shows real GDP growth and the unemployment rate. And again, you see the incredible volatility in GDP from the second quarter into the third quarter of last year. And then starting with the fourth quarter of last year into the first two quarters of this year, you see an increasing trend, culminating in the most recent GDP report for the second quarter at 6.5% growth. By any standard at all, that would be extraordinary growth, but certainly pales in comparison to what we've come through in terms of the rebound that we saw last year in real GDP. The other point that I'd like to make, and this goes along with the normalization theme, is that I think we are going to be seeing the high point of GDP growth for the recent term, the near term here, either in the second quarter or perhaps the third, but very, very soon if we haven't already seen it. So I'm looking for normalizing GDP growth ahead, still strong by historical standards, but coming back down to earth after an extraordinary period. And we're going to see that in other data as well. Very, very high data over this spring, extraordinary levels coming back down to earth, and a mix of good and bad, as we would see in normal times. Not everything is going to be off the charts all the time, and I think that's a reasonable expectation going forward. The other thing that we see in the graph is the unemployment rate skyrocketing up to about 13% on a quarterly basis, and also coming back down to earth. Still a long way to go from a current about 5.9% or so to the pre-COVID level of about 3.5%. Still a long way to go to get back down there. But I think we're going to see an ongoing improving trend. However, the rate of improvement in the unemployment rate is going to start to moderate here going forward. Again, as we start to see more normal economic data, the rate of labor uptake that we've seen, extraordinary levels, going to start to normalize. So the key here is ongoing growth, but with normalizing data. Now, if we can go to the next slide here, we'll see what's going on with some of the inflation data. And this, again, has been central to the discussion and absolutely of paramount importance to many of our clients in recent discussions. And we see here both the producer price index and the consumer price index elevating in recent history, and probably going to stay fairly hot for another couple of quarters before growth starts to tail off and approaching that sort of normal-ish, I'm using the ISH there, normal-ish range of say 2 to 3%. That's probably on the high end of normal range. Now, what we're seeing here with inflation data is three dimensions of inflation that are worth discussing. First is the amplitude, that vertical dimension. We're seeing very strong month-to-month price gains over the headline indexes and a number of products in recent months. So there's a pretty healthy amplitude there. We're also seeing the breadth across a number of products, not just used car products, not just energy, but a whole range of inputs to major manufacturing processes, to service industries, consumer inputs, food, housing, things like that. So we're seeing amplitude, we're seeing breadth, and then the third dimension, duration. And I think we put all those things together, and we do have to take this inflationary impulse very seriously. And really finding ourselves in a unique period in economic history where we have to think about coming out of a period of low inflation in the last expansion cycle, a sustained period of above trend or above normal inflation, well above 2% here for several quarters. Now, of course, that informs Federal Reserve policy, and we're going to see this on our interest rate forecast in the next slide. Excuse me, where we show on the very bottom line here, the Fed funds rate forecast. That's the purple line on the bottom. And when the Fed goes into a crisis, it does three things. The very first thing it does is lower interest rates to near zero. We see that on the left-hand side of this, and we see it toward the middle right-hand side of the graph going into the COVID recession. So interest rates brought down to near zero is step number one for the Fed. Step number two is to begin to purchase assets, bonds, treasury bonds, and mortgage-backed securities to build up its balance sheet, to add liquidity into financial markets, to add some leverage on long-term interest rates. And so the Fed has re-engaged quantitative easing after the Bernanke era, 3 rounds of quantitative easing. We now have the Powell era, the Jay Powell era quantitative easing. And then the third thing the Fed does is special programs, including swap lines and other liquidity measures to handle specific parts of the financial market that may be in stress. It's very important that we consider that sequence: interest rates, quantitative easing, and asset purchases in order, because the Bernanke era playbook was to unwind that sequence in reverse order. And I think that's what we see the Jay Powell Fed doing now, where we've seen the special programs already unwound. And now lots of discussion about the beginning of the unwind of asset purchases. The Fed is still purchasing assets at the rate of about 120 billion per month, weighted toward treasuries, but also including mortgage-backed securities. So the Fed has been engaged in this discussion about how and when to start to wind down its rate of asset purchases. I'm expecting the Fed to narrow the focus on that discussion and probably begin to reduce asset purchases by the end of this year. Now, it's important, again, to remember the sequence. First, special programs unwound, then asset purchases is probably going to take at least 6 months, perhaps a year, to get asset purchases down to that to basically the equilibrium level, where they're just replacing maturing assets and keeping the balance sheet level. Once they get to that point, then we will see the eventual increase in interest rates. And so we have our first Fed funds rate increase in our forecast for the very end of 2022 going into 23. We have an upward slope on the Treasury, on the 10-year Treasury bond. We have an upward slope on a mortgage, 30-year mortgage rate, but these are fairly shallow upward slopes, not steeply upward by any means, but responding to the eventual tightening that's going to come on the short end of the yield curve from the Fed pressure, as long as we continue to experience that extraordinary inflationary pressure, at least for a few more quarters. So the other big policy lever in play right now is fiscal policy. We've had several rounds of fiscal stimulus, culminating in the biggest ever fiscal stimulus program from last March. fiscal stimulus is designed to get a lot of money into the economy very, very quickly. Those were the direct payments to households. Those were enhanced unemployment benefits and other special programs. And now that we've gotten through that phase, we're talking about infrastructure and infrastructure plus from the Biden administration, some real money being discussed in Washington, upwards of $1 trillion for infrastructure, 3.5 or so for beyond infrastructure. The discussions are currently in place. We don't know what the exact final figures are going to be, but the important difference between fiscal stimulus and infrastructure spending and social spending is that fiscal stimulus gets into the economy very quickly. Infrastructure and the other spending that's being discussed now, those are longer term programs, perhaps 5, 8, 10-year programs that are going to be very important for longer term economic growth next year, the year beyond that, and the year beyond that. And so in terms of our long-term forecast, we're really watching this very, very carefully. Now we have to ask, of course, what are the consequences of the huge amount of both fiscal stimulus and proposed infrastructure and social spending in terms of the budget deficit? And if we can go to the last slide here, this is a great example of what the Congressional Budget Office does. It is their charge to forecast long-term budget implications of spending programs in Washington. And you see here on the very top line, federal spending, and that's as a percentage of gross domestic product. And so we're scaling spending to the size of the economy. And we see that over a very long period of time, historical period, that we tend to run about 20% or so federal spending as a proportion to GDP. Sometimes we do more, sometimes we do a little bit less, but the long-term average around 20% of GDP federal spending. So the next line down are tax collections and other collections by Treasury and others. And those are also scaled to the size of the economy. Over the long term, we tend to run about 17% revenue as a percentage of GDP. So 20% spending minus 17% revenue leaves a 3% budget gap. And again, over the very long period of time, the last several decades, that 3% budget gap has been where we've been running, and it requires us to issue treasury bonds to raise money. The issuance of treasury bonds liquefies the global financial system. And Alexander Hamilton thought that was a great idea. And I think it's, a reasonable amount of deficit spending is a very good idea for the US and the global financial system. Now, the concern, of course, comes when we think about how spending potentially may ramp up. And if we can go back to that slide very quickly here, we see on the right-hand side that upward slope of the red line. Again, federal spending is a percentage of GDP. And according to the most recent Congressional Budget Office analysis, the big pressure on that upward slope is potentially interest rates, in terms of interest rates going up and then being a bigger and bigger percentage of federal spending in terms of the debt that we issue. So if we do see higher interest rates in the future, and we do see those that federal outlays line going up and the revenue line staying flat, that means the deficit worsens over time from a perfectly sustainable 3% or so to perhaps an unsustainable, if we go too far in that direction, 8, 9, 10% or so. I don't expect it to get that bad. I think we have plenty of time to change the course here, but we are going to have to think very, very seriously about the composition and magnitude of long-term spending at the federal level and the composition and distribution of tax revenues. And those discussions are currently are in place right now in Washington, and we'll have to see what comes out of Capitol Hill here in the next few weeks. So to wrap up here, a very, very interesting economy, something that is far, far from normal, but starting to normalize. And I think that normalization process, we're going to measure that in many quarters, if not years, after an absolutely extraordinary 2020. Thank you very much.
Okay, Robert, thank you very much for that. I appreciate you ending on a positive note. And we'll see you back here in a little bit for some questions. Okay, so let's go to John Lynch now, our Chief Investment Officer. John, as you come on screen with me, I'm going to say hello to a few people who are watching us who've logged in. Timothy, and wow, my list is growing longer as I'm going here. Delia from Napa Valley, Alma from Tennessee, Tisha from Dallas, Carol from Houston, Tim from Milpitas, California, Gary from Eagle, Idaho. So we have folks joining us from all areas of the country today. So that's a lot of fun. Okay, John, so given all the data that Robert just shared with us, how are the markets interpreting that data?
Yeah, I wish the markets could interpret it as well as Robert highlighted it, because the markets are really seemingly pretty confused about the outlook. As certainly as Robert highlighted, 2020 was extraordinary. 2021 has been pretty good. We do have our challenges certainly with the Delta variant, and as investors become less dependent, if you will, on monetary and fiscal policy. We do have some curious things going on. I think from a market signal, first and foremost, if you look at the chart here on the 10-year Treasury, the 10-year Treasury bond, curiously, in anticipating inflation, right? Everyone expected higher inflation because of the year-over-year comparisons from the trough levels in the spring of 2020. So everyone was anticipating high inflationary or larger than average inflationary readings because of those base effects that the Federal Reserve has referred to. The Federal Reserve has said they would be transitory. So really going into and through the end of the first quarter, the 10-year Treasury bond started the year, maybe 90 basis points and climbed up to 1.75% by the end of the first quarter. And that's all in anticipation of inflation. By the time inflation arrived, the 10-year Treasury yield started declining again. So that was a very, very curious development. I think it's a symbol that the market is confused. I think what we're seeing is that rally in the 10-year bond, the decline in the 10-year Treasury yield, ordinarily would suggest a bond market that is concerned about future growth prospects. I'm not convinced that's the case. I think the bond market is looking at the inflationary aspects of not only monetary policy, but also fiscal policy. The bond market is weighing that inflationary prospect with purely a valuation prospect on global comparisons. For example, if you're a global investor, you have the opportunity to buy the German Bund, which yields negative 50 basis points, or you can look at the Japanese government bond, which is yielding maybe 1 or 2 basis points. Anybody on the call today would view the 10-year Treasury on an absolute basis as expensive. Yet when looking at it relative to a German Bund yielding negative 50 or a Japanese government bond yielding 1 or 2 basis points, for those investors, the 10-year is a screaming buy. And I think what's driving the 10-year is that relative valuation. I'm sure there's some degree of concern or skepticism about the Delta variant, but nonetheless, I think the primary driver is global flows into the 10-year Treasury. A, from a valuation standpoint, B, from a confidence standpoint in our path of recovery, and C, our ability to repay that debt. So I think that's what's driving it. And another thing that helps me with that assessment, if you look at the next chart, we're seeing, Susan, a lack of credit stress. So the 10-year yield has plunged 50 basis points over the last 3 or 4 months. If the bond market truly believed there was impending doom or trouble around the corner, I think you would have seen it in corporate credit. What we have here are the interest rate differentials or the spreads between investment grade credit and high yield credit. And as you see here on the chart, both high yield and investment grade spreads have barely budged. So the fact that we don't see credit stress in the spread sectors, I think is a very important development. And I think it can enable investors to appreciate the fact that the bond market is not necessarily signaling trouble. It's ultimately signaling a stable recovery. I do believe that particularly when you look at flows into TLT and some of the bond ETFs. I think they're peaking right now. And I suspect, as Robert highlighted, as the economy normalizes, I think you're going to see the 10-year Treasury bond normalize, and we'll see slightly higher interest rates before year end, and then gradually higher interest rates in 2022. So we'll continue to position portfolios short on interest rate sensitivity and long on credit quality.
Okay, John, we've seen S&P at record levels this year. Why is that, and what do you expect for the future?
Sure, the S&P, another confusing signal. The S&P is hitting record levels, and I think clearly investors are excited about the recovery prospects. But I want investors to really appreciate the composition of leadership, and this is something we've written about quite a bit. If you look at the chart here, the S&P has been on a very steady pace higher. It's been among the most impressive I've seen in my career. I also think it's important to point out that the black line is the index itself. The blue line is the 50-day moving average. And I think that's a really important development because you see, anytime the S&P 500 has run into difficulty, it tends to find significant support at that 50-day moving average. So that is an important technical development. But I also think it's important for investors to recognize, as I mentioned earlier, the composition of leadership. Throughout the first quarter in 2021, when the 10-year Treasury yield was climbing, we saw cyclicality lead this market. We saw value, we saw small caps, we saw cyclical sectors driving the S&P higher. Since the 10-year Treasury peaked at the end of the first quarter into the beginning of the second quarter, and really for a couple of months, call it April and May, we still had cyclical leadership in the equity market. But really in June, July timeframe, what we've seen is that we've seen a reversion back toward the stay-at-home trade, if you will, mega cap leadership, big five technology. You're not seeing the participation that we've seen previously. And I think that's a couple of things. I think it's a market that's, buying into the head fake that the 10-year Treasury yield is sending. It can be a concern about the spread of the Delta variants. But I ultimately believe it's just kind of a comfort factor, if you will, in the dog days of summer. And as Robert highlights about his economic growth outlook and his prospects for inflation, I think we're probably susceptible for some near-term weakness. But I think ultimately what you're going to see is a resumption of cyclical leadership. We're seeing it in commodities, copper's outperforming gold, cyclicals in Asia, cyclicals in Europe are outperforming. So I just think we're in this kind of trough period right now for cyclicals before we bounce up. We may need to have a 5 or 6 or 6 or 8% type correction in the near term. But I think ultimately those strong growth prospects, both domestically and globally, will start to see a resumption of cyclical leadership going forward.
And that makes a lot of sense, John. Let's talk about momentum versus trend. And what do people need to know about that?
Yeah, I think this is a very important signal for investors. If you look at the chart here, we talked earlier on the previous chart about the S&P 500 hitting record levels. I talked about how the composition of leadership had changed. And this is really descriptive of how the composition of leadership has changed, because since we switched to, if you will, the big five tech companies leading over the past couple of months, we've seen a decline in momentum. And as I define momentum, it is the percentage of stocks in the S&P 500 index that are trading above their average price over the past 50 days, otherwise known as the 50-day moving average. Trend, on the other hand, is the average price over the past 200 days, or essentially a year of trading activity. What we've noticed since cyclical leadership gave way to big five tech leadership, since the reflation or recovery trade gave way to the stay-at-home trade, we've seen a significant decline in momentum as the number of stocks trading above their 50-day moving average has plunged from about 90% to around 50% today. Fortunately, and I want to really emphasize this, what we've seen historically is anytime you have weakening momentum during periods of solid trend, any near-term weakness tends to be buyable. So that kind of fits into the, I suspect we are susceptible for a near-term correction. Can't tell you, can't guarantee what the catalyst could be. It could be, Delta variant. It could be concerns about, debt ceiling debate once Congress comes back into session. Nonetheless, I do think we're poised for some near-term weakness because of this deterioration in momentum. But fortunately, trend remains supportive. And anytime you've had weakness in momentum during periods of solid trend, which we're experiencing currently, historically, those have proved to be viable periods, and we will take advantage of that for our investors.
Okay, so correction may happen. We'll be prepared if it does. Next question I have for you, John, is, you always stress sticking with the fundamentals. So how would you describe the fundamentals at this stage of the game?
Thank you, Susan. In two terms, I would call it earnings and interest rates. And as we've discussed, as Robert discussed, as I discussed, interest rates are heading higher, but from exceedingly low levels. I want investors to keep in mind that the 10-year Treasury might be yielding 1.2, 1.25% today. Since World War II, the 10-year Treasury has averaged something like 6.75%. So we are dramatically below long-term levels on interest rates. And the Federal Reserve is certainly claiming and projecting that they're going to keep short-term interest rates as low for as long as possible. So interest rates are a tailwind. Earnings have been nothing short of magnificent. We're reporting second quarter earnings now. Looks like earnings for the companies in the S&P 500 from year-ago levels are going to be up 90%. I mean, it's just a stunning reporting period that we're experiencing with companies that have really benefited from 20% sales growth. Again, we're compared to trough levels from last year, but nonetheless, I think what's most important is that companies have tight income statements. So when you have a tight income statement, what we've seen is that there have been low interest costs, there have been low wage costs, and then you get this boost to the top line or boost to sales. So therefore, you can trickle down to the bottom line that more quickly. So consequently, what we're seeing is 90% earnings growth. I think it's a safe assumption to say that's not going to continue. But I do believe that as companies firm up and as companies get closer to historical trend growth rate, we think that is a very positive development, because right now what we're looking at are record profits being discounted near historic lows in interest rates. And when you're discounting record profits near historic lows, you're not only enhancing the present value, but future value of those earning streams. So with low interest rates, you're able to discount at more attractive rates, thereby making your longer term investment more worthwhile, if you will. So we're confident in companies' abilities to deliver solid earnings. We're also confident they're not going to deliver 90% going forward. We're projecting earnings growth of more historically average earnings growth over the course of the next year. We think the S&P 500 is probably within 2 or 3 percentage points of fair value. Yet nonetheless, we get this sort of near-term correction, as I suspect is in the offing because of that deterioration in fundamentals. We do believe, or a deterioration in internals. We think the positive fundamentals would be supportive because of low interest rates, good earnings growth, and then consequently, we'll continue to position portfolios for this cyclical recovery that we envision. And in portfolios, we'll be overweighting small relative to large, value relative to growth, emerging relative to developed within the equity component of our clients' diversified portfolios.
Okay, John, so glad we have you at the helm. So thank you for all of that
Thank
great
you.
information.
It's a labor of love.
Yes. Okay, now we're going to move to the Q&A part of our program. So we'll bring Robert back up. Robert, we're going to get started here with questions about the housing market. We have quite a few. It's a theme. So I'm going to combine a couple questions. We have Casey asking, are we nearing the end of a seller's market, going to more normal housing prices? So think about that. And then Lillian is asking, we've been witnessing the increases over the past 12 months? I know we talked before about double-digit increases in housing prices. Will this affect the economy negative in the long run? What are your thoughts on housing market going forward?
Great question, Susan. Of course, everyone is concerned about the housing market with the Case-Shiller House Price Index up over 16%, and National Association of Realtors, their existing home price index up 23, 24% year over year. These are extraordinary numbers, and certainly remind us of the extraordinary period in 2007, 2008, where we also saw double-digit house price gains, and so we all know how that ended up not so good. So what's the key difference? Well, back then it was a demand-driven market, and we had very lax mortgage standards. People could, with very low qualifications, could qualify for multiple mortgages, and so the demand side of the market really took off, and that ended very, very badly. So now what we find ourselves in is a supply constrained economy, and the inventory of existing homes and new homes for sale has been very, very tight. And if you've been in the housing market lately, you know that you have to walk around with a checkbook in your back pocket, and if you see something you like, you better make an offer, and it better be a good one and a quick offer. So my expectation is that the rapid increase in prices, the very strong increase in prices we have right now, is starting to push against affordability and is starting to push people out of the housing market in terms of potential buyers, especially first-time buyers. And so my expectation is that the inventory levels start to creep up. We've already seen a little bit of that, both in new and existing homes. And as the inventory, the month supply of available homes creeps up, the price pressure will decrease. Now, I don't look for prices to go backwards, but I do look for increases to start to normalize, going from mid double digit to low double digit to eventually high single digit, and over the long term, maybe 5 to 6%. And we could have an overshoot. We could have a period of fairly weak price gains, maybe 2 or 3 or 4 years down the road. But I don't think we're going to have the sudden violent correction in the housing market that we saw a few years ago, back with the Great Recession. And of course, it's a two-edged sword with house prices. So even though we are pricing some people out of the market right now, if you do own a home, you're gaining a huge amount of equity with low interest rates and strong price gains. And that is a very strong support for consumer spending, a positive wealth effect for households, because for most households, the house is their biggest store of wealth. So I think we will see long-term positive economic consequences from the recent tight market. We're going to see builders gaining more confidence and doing more building. And we're going to see a strong support to income from the positive wealth effects. So hopefully we get through this again with normalization and moderation rather than a gut-wrenching correction that we went through in 2009 and 2010.
Right. We would not want to see that again, Robert. Thank you. Okay, John, next question is for you. This is from Stephen. For the remainder of 2021, how do you expect commodities to perform, including gold, energy, and agriculture within the general commodity space? Is there a specific area that you expect to outperform?
Yeah, thank you, Susan, and thank you, Stephen. Yeah, the commodities market is another example of market confusion, if you will. So for what we've seen thus far, gold has underperformed copper, for example. And I like to look at that ratio because it's really about industrial metals relative to precious metals. And it really breaks down, I believe, global investor confidence in the economic outlook or the economic recovery. And what we've seen, copper has dramatically outperformed gold on a year-to-date basis, and that trend is very powerful as far as I'm concerned. Stephen, you may be familiar with the fact that copper is referred to oftentimes as Dr. Copper, because Wall Street believes that copper has a Ph.D. in economic forecasting, because as copper prices go, so goes the global economy. So I will continue to watch that ratio of copper relative to gold. And that tells me that the global economy or global investors are confident in the economic recovery around the world. Another point I want to keep in mind is that inflation hedge, gold as an inflation hedge, only works sometimes. All too often we think it's a lock, and that's not the case. Gold has underperformed this year, and certainly we're seeing 5% inflation growth on a year-over-year basis. So from that standpoint, I'd be careful looking at gold purely as an inflation hedge. I would encourage you rather to look during difficult periods, gold as a safe haven as opposed to an inflation hedge. Third primary commodity I like to look at is oil. Oil prices, WTI is probably hovering in that $70 range this afternoon. And I think it's important to recognize a couple of dynamics going on here. First and foremost, gold has been through a dramatic recovery, even probably twice that of what copper has benefited from this year relative to price gains. But oil was concerned, obviously, oil investors were concerned about supply constraints, bickering between the cartel that never acts like a cartel, OPEC, and now you expand OPEC plus. We finally, within the last several weeks, 3 or 4 weeks, we've received confirmation from OPEC plus that they will gradually increase production back toward pre-pandemic levels. They're not going to totally pump to get back to where we were, 15, 16 months ago, but gradually over a several month period, release an additional 500,000 barrels a day, 400,000 barrels a day over the next several months. So it's going to be a gradual decline, gradual rather increase in production, which should ultimately, I think, keep oil prices in that $70 to $75 range before year end. So to categorize my view, thinking about copper, oil, and then gold as you're positioning commodities within your portfolios.
Jen, I'm going to have both of you can weigh in on it. So Christopher is asking, provide details as to inflation, the unique impact on various markets. Specifically, a question that came in from our live cast here. Someone is asking in California, specifically food processing, because we know that has seen a lot of inflation there. Okay, so that's the first part. And then the part for John is this inflation are we already seeing it in stock prices as well? So Robert, you want to start and then John can finish.
Yeah, I'll talk a little bit about food inflation because normally when we're used to thinking about volatility and inflation, it's energy driven. And some of that has been true. We have seen, as John just said, an increase in oil prices from say 40, 45 bucks up to 70, 75. But we're also seeing it in food and food away from home, food purchased at grocery stores for home consumption. Prices have gone up. This is an interesting phenomenon to me because quite often we start to see some consumer pushback and consumer displeasure at food price increases above, say, 2% a year. We're now at 3, 4, 5%, various food groups. It's interesting because there's a lot of savings out there. There's a lot of the fiscal stimulus money that didn't get spent out. And so the savings rate over the last year or so has been highly elevated, especially in months where we had a lot of fiscal stimulus, including March. And so there is some cushion out there for many households to absorb these food price increases. However, I think that over time, we're going to start to see consumer groups complain a little bit more about these price gains. To date, consumer confidence has done very well. Both business and consumer confidence has come back up. Consumer confidence is just about where it was, according to the Conference Board's measure, just about where it was before the COVID recession hit. And so that's very nice to see that. But there again is potential there for inflation to be sustained, to be above what's comfortable, and for eventually that padding on the consumer side in terms of an elevated savings rate to eventually run out and households feeling more and more of a pinch from these higher food prices. So that is a concern.
Okay, that makes a lot of sense, Robert. So John, tell us your part of it. Do you remember that you're part of the question?
I do. And thankfully, Robert had a long answer, so I was able to get some thoughts in my head to address it. First and foremost, the first thought that popped in my head was Milton Friedman. Milton Friedman had an award-winning economics career on the idea that inflation was always and everywhere a monetary phenomenon. And when you think about all the quantitative easing that global central bankers have done over the past 12 years, let alone the last 12 months, Friedman has to be spinning in his grave right now, thinking about all the excess liquidity that's out there. So, one, we have excess liquidity, trillions globally in excess liquidity. Secondly, I'm glad the viewer asked this question because asset price inflation is very much a part of inflation, but it's all about perspective. Companies have been buying back shares uh, dramatically over the last 7, 8 years. So we're seeing more liquidity and fewer shares. So if you have more dollars buying fewer shares, clearly you're going to have asset price inflation in the equity market. But what I think is most important, I used an example earlier talking about the 10-year treasury bond, saying the 10-year is expensive at 1.2 on any absolute traditional valuation metric. But when you look at it on a relative valuation metric to the German Bund or the Japanese government bond, doesn't look as expensive. Now, with the equity markets, looking at maybe $200 in earnings on the S&P 500 over the next 12 months, call it the S&P, call it 4,400 right now, just to make the math easier. That's a 22 PE on the market. Historically, the market, the price to earnings ratio has been about 17 times. So we are 5 points higher than the long-term average. But that long-term average goes back to World War II. And I mentioned earlier this afternoon that the 10-year Treasury bond has yielded on average 6.5 or 7%. Inflation, the consumer price index, has averaged historically 3.5 or 4%. We're higher than that now, but few believe that 5% will be sustainable going forward. But nonetheless, if we're about 5 full percentage points below the long-term average for the 10-year Treasury bond, that certainly bids up. I talked about discounting future earnings at low interest rates. So on an absolute basis, the market may seem expensive, but on a relative basis, particularly relative to interest rates, we don't view it as oppressively overvalued, and certainly we think we're fairly valued, 2 or 3 percentage points higher currently. But asset price inflation is very important to keep in mind. But I would encourage all investors not to look at asset prices on an absolute level, but always factor in earnings inflation, PE ratios when making investment decisions, and that's how we're viewing it.
Okay, John. Robert, we have a few questions coming in about the extreme heat and drought conditions in the Western states this year, and question about concerns about the electric utility and energy grid possibly happening in the next month or so. And then also with the drought, any concern about new construction, knowing that that's happening?
Well, yes, Susan, I think there are both short-term and long-term concerns here. And in the short term, if there is strain on the electrical system, if there is ongoing water rationing, we're starting to see some of that now. That is a constraint to businesses and obviously an uncomfortable situation for households. So in the long term, it potentially could reduce the desirability of an area if there's if there is deemed to be an unreliable or very expensively priced electrical grid, and if there are deemed to be long-term questions about water supply, then businesses might choose to not locate there or relocate out of a particular region. So this is a concern. And what I expect to see is some significant investment in infrastructure over the next few years. And I think some of that's going to go into the electric grid. But in terms of water supply, I don't know if there's much we can do to legislate more water supply, particularly in a very constrained state like California. So if we are seeing long-term drought conditions, that could definitely impact business performance and as well as household comfort and eventually household decisions about where people locate as well.
Okay, Robert, question from Rich asking, if you had a crystal ball, when will the labor force get back to normal? He says we're hurting in the construction industry. We know that's not the only industry that's hurting, that's having trouble getting workers right now.
Yeah, that's a big issue. And again, talking with clients to a person, every client that I've talked to in the last couple of weeks has had difficulty hiring people, difficulty retaining people. One of the things that we're going to be seeing in terms of the policy levers in play right now is we are going to be seeing an end to enhanced unemployment benefits, that extra $300 or so a week in terms of an enhanced benefit that got paid for with the last round of fiscal stimulus. Most states now have already opted out of that, but not all states. All states will be done with that because the federal funding expires right after Labor Day. So that enhanced benefit is going to go away, and I do expect to see more workers, more idle workers coming back in to look for jobs. There's an awful lot of job openings out there, roughly 9.2 million, according to the latest JOLTS report, about 9 to 10 million unemployed workers out there. So it seems like we've got the numbers out there to see normalization in the labor force, but getting the right workers with the right skill set in the right place, I think is going to take some time. So I think this is going to feel like a tight labor market here for some time to come, well into next year, perhaps through the end of next year, ongoing declines in the unemployment rate, and probably complaints by business owners about how hard it is to hire and retain staff for some time to come.
Okay. We're just about at our time, but we're going to squeeze in one more question. And this is for John. Question from Lou. He's asking, when will the market start to build in stock prices of the proposed Biden tax increase?
I'm glad Lou asked that question because Wall Street consensus for next year is looking at $220 in operating earnings, call it. And we're still in print at $200 in operating earnings for just that reason. I want to make sure we get a good handle on whether or not it's going to be 28 or 24 or 25% on the increase in cap gains, because right now at 21%, the market is valuing 2022 earnings on a continuation of no change in the capital gains rate. And I think that's a mistake. So I'm glad Lou asked that question. If we go to 28%, as the administration is proposing, that should represent about a 10% hit to earnings forecasts for 2022, which would suggest, therefore, that earnings could essentially be flat between 2021 and 2022. That's not a condition the market is priced in. I don't think, given the balance of power, if you will, in DC, I don't believe you're going to get a 28% number. If it's something along the lines of 24, 25% to help pay for infrastructure and the 3.5 trillion reconciliation package, I think something like that would still be viewed as palatable to the equity market, and you would probably only see a 4 or 5% hit to earnings growth next year. So it would be less impactful, certainly, to profitability and stock price valuation with the lower rate that I suggested.
Okay. Well, on that note, we're going to wrap it up. Thank you, Robert and John, so much for joining us today and sharing all your knowledge and expertise.
Thank you. It's been our pleasure.
Great. Awesome. So our next Outlook on America event is going to be happening on November 9th. So we hope to see you there. And also I wanted to mention we have our Women's Business Symposium coming up on October 21st, and we are going to have a wonderful lineup of women speakers, and it's a great event to get inspired and motivated. So we would love to see you there as well. Just go to Comerica.com for more information on that. Now for this event, you'll receive a link in your email if you want to watch it again, or if you want to forward it to someone. We would really appreciate it. So thanks again for spending your time with us today, and hope you have a wonderful rest of the day.